you own shares of Vanguard's target date 2025 fund in a taxable brokerage account, listen up. Hi, I'm Jim, a financial educator at wallethacks.com. Follow me and I hope you sound smarter than your friends. At the end of every year, mutual funds, especially target date funds, are going to send out distributions, a percentage of their net asset value. So if you hold funds in a tax deferred account like a 401k or an IRA, this won't impact you because those taxes are always deferred. If, however, you own them in a taxable brokerage account, you're going to have to pay capital gains taxes on these distributions. Vanguard Target Date 2025 fund is estimated to pay out a 4.29% distribution. This means for every $1 million invested, you're going to pay taxes on $42,900 of capital gains. Depending on your tax bracket, if you're in the highest tax bracket, you'll pay $6,435 in taxes. And this is going to be higher than most other target date funds, even though Vanguard's gets some of the highest ratings. And these funds make adjustments, especially these target dates where they adjust the stock and bond asset allocation. They're going to have to sell stocks to buy bonds, and that's what's triggering a lot of these capital gains. And sometimes you could see this as a good thing because it shows that the stock market has done really well if they have to make these adjustments at the end of the year. The asset allocation has to be within line of what they want. And so if your stocks are doing really, really well, they have to cycle them over into bonds. If you're a holder of this fund, there's no way to avoid it at this point, but it is important that you prepare for it because you will take a tax hit. If you want to avoid this in the future, really the only way to do it is to hold these funds in a tax deferred or tax-free account. These are your IRAs, either Roth or traditional, or in a 401k or some other employer-sponsored plan. This doesn't mean that Vanguard's target date funds are bad. It doesn't mean target date funds are bad, or these life cycle funds. They're good because you can set it and forget it. Unfortunately, sometimes they'll trigger some of these capital gains, and it's something that you need to be aware of at the end of the year.